Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today's Tuesday, April 21, 2015. Inside the numbers tonight, we're going to discuss the SPY and the EMini and why we're at a critical juncture right now. It's very important. The market is at a number that I've actually given you a few times, and I said we have to close above or below for it to be meaningful, and we're there again. So this is on the EMini, but I'm going to explain everything. I want to explain a little bit about process, and if you got the email tonight, you've got the precursor. I'm going to talk about the process I go through to find stocks to put a trade on. We're going to talk about crude oil. We'll talk about gold and the GDX, interest rates in the bond market, and we'll wrap it up with the US dollar. Okay, so let's get into the charts. That's Yahoo. We don't want Yahoo. Yahoo had earnings after the bell today. I was just watching that. Okay, so here's the EMini. I'm sorry, this is the SPY. And today was more or less a flat day. There was not a lot of action going on, not a lot of trading going on in one direction or the other. Market actually looked like it was going to open up big this morning, but it never materialized. It opened up and then it just sold off, and I'm trying to get the intraday chart up here. Here we go. See, we went up, and then we just crapped out right away. Basically traded sideways all day long, threatened to break down a couple of times, but light volume is typically going to hold the market up and not let the downward pressure take hold, because there's really no force of sellers out there when there's light volume. If you have a market going down on heavy volume, that's different. When you have a market trading on light volume and it ticks down 1, 2, 3 points, it's not going anywhere. Okay. Okay. So now let's go to the EMini for a second, and I'm gonna discuss a little bit about where we are, that number, that critical number. So let's go over to the intraday where we are. Okay, good. So a couple of days ago, I told you basically 2090, 2091, that was going to be an important number, okay? And it's an important number. So and you can tell it's an important number because right at the close today, we went right back to 2091. At the open today, we opened up, and then we sold off, and we went through 2091. We hovered around 2091. Here, let me show you 2091. Okay, here's 2091 right here, okay? So we sold off to 2091, we hovered around it, broke down below it, above it, below it, above it, and above it. Okay, so we're only above it by basically 50 cents, half a point. So 2091 is important. So what's the deal? The deal is this. The market is building. Let's go over to the daily chart, okay? Well, actually, I'll tell you what, it's more prevalent on the weekly chart, okay? You see all this? This is the market not going anywhere for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. Almost 3 months the market hasn't gone anywhere. But when you read in between the lines, what this is telling you got to peel back the onion a little bit. And what this is telling you is the market is churning around, building up pressure because it's going to go in one direction or another. The longer it goes sideways, the bigger the move is going to be when it breaks out either above or below. Okay? Now, you'll know that I think that we have higher prices coming in 2015. But that doesn't mean tomorrow or Thursday or Friday or next Monday the market can't break down and have a decent sell-off. Okay? So this pressure that we're building up here, okay, well, this is the 60-minute. Let's go to the daily. When I say we're going to break down, and if we come down to 2070 or 2055 or even 2020 or even worse, okay, that, and also on the flip side, on the upside is, and where do we know, let me back up. How do we know that we're in a bullish tone? Okay, well, we don't know it yet, but what are we going to use as a benchmark to tell us the market's going higher? 2105. We have to close hourly and then daily above 2105. Now somebody's going to say, but what if the move is already half over by the time we get there? I want to be in early. Now that's the difference between a professional trader and somebody that's looking for the big hit that really doesn't understand what they're doing in its full entirety, okay? The difference is this, okay? And this goes into the process, so I might as well start talking about the process for a second. The process, and basically, let's wrap up the S&P. Above 2105 is bullish. Below 2091 is bearish. It's that simple. Okay, so we're right on that number tonight. If we start trading and close hourly below 2091 tomorrow, okay, there's probably lower prices coming. If we close hourly and then daily above 2105, then we have 2115 and 2120 and 2130, 35 that we've talked about since last November or December. So we'll talk more about that as we get closer, but that's where we are. We're really in the same place we were yesterday, but it's very defined. Below 2190, bearish, 2191, in that neighborhood, above 2105. Okay, back to the process. So the difference is this. When I'm willing to buy the S&P EMini contract only above, or the S&P or whatever I'm buying, but only on a close with the S&P EMini above 2105, even if I limit myself, let's say the upside's 2115, and let's say I only get 7 or 8 points out of that, okay? Because it starts going up, and then I wait for the hourly close, and then I buy it. Okay, I'm waiting for what's called a confirmation, all right? Confirmation can be on a daily basis, on a weekly basis, on a monthly basis, hourly, 10-minute, all the way down. So when I say I'm waiting for a close, I want to see the market tell me that it's bullish, or I want to see the market tell me it's bearish by closing 2 candles, 3 candles, 4 candles below a certain level. That tells me it can't get above or it can't get below, whatever the case is. So what happens is, while you may get in now and we may see 2115 on Friday, let's say that happens, okay? You've gotten more of the trade than I did, okay? And you've made more money than I did. But here's what I know for certain. Okay, because I've been doing this over 20 years. I've been doing this almost 25 years, a long time. Okay, I know this from the School of Hard Knocks and from the bruises I have. Okay, that more often than not, if we were to buy this here, okay, more often than not, it's not going to play out the way it'll play out when I know there's a close above 2105. I have a higher probability of success. Right now, I can't tell you the market's going to go to 2115. But if we get above 2105, I'm 100% sure we're going to 2115. Are we going to get there 100% of the time? No. But I'm 100% sure we're getting there, which is why I take the trade. But I'm not even close to 100% sure now down at 2091. What happens tomorrow if we open up at 2075, 2080, and you've taken the trade today up to 2115 because I said it might happen? Okay, well, you're in the hole and I'm in cash. Who's better off? I'm going to get to buy the market at lower prices, okay? That's the way it works. And when you can understand what price levels to buy, what price levels to sell, where your support and resistance levels are, that's when you become a trader that makes money on a consistent basis and can do this for a living with much, much more certainty, much, much higher probabilities than 99% of the people out there. So I also wanted to touch, and that's a good lesson for tonight, but I also wanted to touch on how I look for what to trade. So I'm going to run through that quick because we took a lot of time on the other thing. But so what I have is a watch list like everybody else. So I have maybe 250 stocks on my watch list. There's a few stocks in every sector out there, and then there's a few other things I look at, and there's a lot of stuff, okay? And it's all the normal suspect names, all the names you see me putting out in the trade alerts. It's all the high-flying names. It's everything we know. But here's what happens. I run through that list at least once a day, okay? Most of the time, most of the stocks I run through many more times than once a day, but at minimum, I'm looking at every single stock on that list, a minimum of one a day. And I narrow it down to what looks good. Okay, so let's just take one for example. All right, let's go to Alibaba. Let's just pick on Alibaba for the heck of it. Okay, that's not doing anything. I take a look at Alibaba, and what I have is I have 4 charts on my screen. I have a 10-minute, a 60, a daily, and a weekly chart. Okay, in 4 boxes. 1, 2, 3, 4. Boom, like that. Okay, so when I look at Alibaba, I see 4 pictures right in front of me. I see the 10-minute, the 60-minute, the daily, this is the daily, and the weekly. And what happens is if I see a pattern that looks bullish or looks bearish on the 10-minute, I go to the 60 and I say, what does it look like there? Then I go to the daily, and I don't have to worry. If it's an intraday trade or a short-term swing trade, I'm not worried too much about the weekly, but it can play in, and I look at all 4. And what happens is if I have conflicting information on 2 of the charts, I throw it away, I go on to the next one. But if I have information that confirms one way or the other, upside or downside on the 10-minute, and it confirms on the 60, and if it confirms on the daily, well, then I start looking closer. Then I'll go to the daily. In fact, let's get Alibaba out of here. Let's look at something else. Let's look at something that's moving a little bit. Let's look at Microsoft. Okay? So here's a daily chart. Now, yesterday, let's say I see the 10-minute chart before yesterday. Let's just say it's before yesterday, and we're down here. Okay? Yeah, big move yesterday. You're down here. Do I see anything that's telling me it's going higher here? No, not necessarily. Let's look at the 60-minute. We were down here. Okay, anything telling me it's going higher? No, nothing at all. Okay, the daily, we were down here. No, it's not telling me it's going higher, so I would just pass. Now, it went higher, but the market didn't tell me it's going higher. Okay, so if the market's not telling me it's going higher, then I'm not going to look at that thing twice, and I'm just going to move on to the next one. So let's say I see a market coming into a support level. Let's say we're over here in Microsoft, okay? And we're in this area, we're here, and we start to break down, and I see us coming into a support level here. I'm going to put this on my watch list, and I may be interested in buying Microsoft at $40 a share. Why? Because it's a support level. Let's go to the bigger time frame. That's what I would normally do. I go to the bigger time frame. If I'm on a daily, I'll go to the weekly. See all this. See how 40 was support 1, 2, 3, 4, 5 weeks. At some point during 5 different weeks, 40 is support. Okay. Now, if 40, well, it was 4 weeks at this point. So 4 weeks, 40 was support. Now, eventually it's going to break down, but if now all this is support as well, okay, you have all this support here, you have support here, you see where the market is trending, then I use other methodologies like Fibonacci calculation. I'll use other mathematical calculations. I'll use other methods of telling me whether the market is likely to hold or not hold support. And then, if it looks good to me, I put it on my radar screen, and 40 is a good number. Why? Because 40, like 30, like 50, like 100, like 20, like 10, those round numbers tend to at least promote bounces along the way, if not sustainable rallies. They rarely get cut through like a knife. And if you look at here's 30. Where's 30? Okay, here's 30. See how the market fought 30? We're fighting 40. Where's 50? What was the upside here? $50, and how high? $50.05. I mean, I can't explain it any better than showing it to you. A picture's worth 1,000 words. Those big round numbers tend to be support and resistance for markets, okay? And less so on a dollar basis, but more on an intraday basis, 31, 32, 33, 34, like that. Specifically 35, 40, 45. So all those things play in. So when I see a lot of factors that play into a potential trade setup, I put it on my radar screen and I decide whether or not I want to buy that or not. So I'm narrowing it down. So I've got a lot of things on my watch list. I'm not just seeing something that's up or down, big for the day and saying, let me buy it, let me sell it because it's probably going to bounce. It's less likely or less probabilities of it happening than the way I do it. So that's the reason I do it that way. So I just thought you'd like a snapshot of one of the methods I use for narrowing it down, how I select various equities or various stocks for myself, for the portfolio, and or to trade, to put out as trade alerts. Okay, I know this is long-winded, so we're going to run through the rest of the markets, and then I'll let you off the hook tonight. Gold had a nice up day. There's probably more upside. I've been calling for more upside in gold as long as we hold above some of the critical junctures, and I'm going back to the daily chart. And this is GLD. Let me go over to spot gold. As long as we hold right now, as long as we hold above 1201, it was 1190 was important, 1200 is important. Then I think we still have the promise of more upside. So nothing's really changed. I haven't changed my tune specifically as long as we stay above the low here. The low here is. I can't get it. It's unbelievable how that pops up like that for some reason. It's only when I'm on the recording software that it happens like that. Well, the low here is right around 1181. So if you remember, 81 number from last week. So as long as we stay above that level, that's a critical juncture. A more critical juncture for the shorter term is 1200 right now. So I think there's higher prices coming. Where's the upside? Well, right now you still have to get above 1212. Let's go to the hourly chart and I'll be able to show you better those levels. Okay. 1212 from up here. Okay. Then you have the 200 period moving average on the daily chart is also, it's sloping down. So my prior level was 1240, 1241. But as this is sloping down, that number drops somewhat, so I'm going to say 1235. 1230 to 1235 is the secondary upside target. So you have 3 upside targets. I only gave you 2. I'm going to give you the third one. Your first one is 1212, your second one is 1220, and your third one is going to be 1235. Okay, and you have to stay above first 1200, 1190, 1191, and then 1181. So you have a pretty defined market in gold to trade around. That should be good enough. Oil came inside of our top end trend line today, so there was some weakness there. So it's not out of the question that oil could trade lower back away from the trend line. If the trend line, this upper trend line in this range is deflecting the market, okay, it could be telling you that there's too much resistance up here and the market needs to pull back and consolidate further. Now, what happens if you go sideways to lower for an extended period of time? Okay, then the story changes and that could turn into a bullish scenario. You have an upsloping 20 period moving average, and if you move sideways and don't have any big moves down, and you certainly, if you stay above inside this green bar, which is about 55. So if you stay above 55, okay, and you go sideways above 55, then the market's setting up to go higher. And the higher number I talked about the other night was 58 to 60s. Now, I still have an indication for those numbers, but you've got to maintain the market above this upper trend line in order to take a run at 58 and 60. So that's pretty well defined in where we are on crude oil as well. Let's go over to the bond market. I'll take a look at TLT for you. We had a slightly down day, but we're doing nothing. In the middle of the range, top end of the range, bottom end of the range, middle of the range. However, this is also building up like a slinky. It's stretched and it's going to snap one way or the other. Okay, higher or lower. If I had to have if the stock market's going to go higher, I would suggest the bond market's going to go lower. But if we get a sell-off in the stock market, if that 2091 doesn't hold in the stock market, then I think your break is going to be lower in the higher in the bond market with lower yields coming, and the yields look like this. If the yields break lower, okay, you're going to come down to break below this level. I've given you 1.8 for a while now, and we've held above 1.8, but we can come lower than that down to 1.75 if the bond market rallies, interest rates go lower, probably because the stock market is going lower. So that's a pretty well-defined trade or possible trade in the bond market, if you will. The dollar. The dollar, I have higher prices coming in the dollar. It was flat today. It didn't do anything. But this day here should be a good low. Okay, so we traded it from 100 cents down below 98. I had 98. We went below 98. And then the other day I told you we were putting in a loan. We should see higher prices in the dollar. And I think we're going to trade higher, hopefully for the remainder of this week in the U.S. dollar. Not much more to report there. It was a flat day. I think higher prices are coming. Therefore, that's the position I've got. Okay, so I think that's enough for tonight. It's definitely a longer video, but hopefully the stuff I talked about tonight was helpful for you, and we'll see you on the next go-around. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.